everyone. Ready for a deep dive into something that might sound a little um, dry at first, but trust me, it's way more interesting than you might think.
Definitely.
We're tackling bond insurance today, and you've given us some really fascinating sources. We've got like everything from the basics to some pretty complex scenarios, so buckle up.
Yeah, it should be fun.
To help us navigate this whole thing, we've got an expert here.
Happy to be here. Excited to unravel this world together.
Okay, let's unpack this. First things first. What exactly is a bond?
Well, you can think of it like a financial contract, a promise backed up with some serious weight. Even the Cambridge Dictionary keeps it pretty simple. It's a written promise.
So like a super official IOU, but with a lot more on the line.
Exactly. And one of the things that makes a bond unique is that there are three key players. Unlike, typical insurance where you just have two. You've got the surety, the principal, and the beneficiary.
Okay, break that down for me. Who's who in this financial triangle?
Think of the surety, often a bank or insurance company, as the guarantor. They're the ones vouching for the principal, who has to actually do something, fulfill, some obligation. And then there's the beneficiary. They're the one who's protected if the principal doesn't hold up their end of the bargain.
So it's like a safety net for the beneficiary, making sure they don't get left hanging if the principal drops the ball.
That's a great way to put it.
Now, here's where things get interesting, and this is something I bet you've encountered in your own life, this concept of right of recourse. What's
Sure.
that all about?
So this is where bonds differ from typical insurance. If the principal doesn't deliver, the surety actually has the right to go after them to try and recover that money they had to pay to the beneficiary.
So it's not just absorbing the loss, they can actually chase them down to make things right.
Exactly.
It's like if you lend your friend money and they promise to pay you back and they don't, you're going to try to get your money back, right? The surety is doing the same thing just on a much larger scale and with a lot more paperwork.
Precisely. That's why careful underwriting is so crucial in the bond world. Sureties need to assess not just the likelihood of that principal fulfilling the obligation, but their ability to recover funds if things, go south.
Okay, so we've got the basic definition, but what kinds of things are actually being guaranteed by these bonds? What are some of the most common types that insurance companies deal with?
Well, our sources mention a whole spectrum of bonds, from immigration bonds and bid bonds to performance bonds and even customs bonds. It's a pretty diverse field.
Customs bonds. That sounds kind of intense. What kind of situation would require one of those?
Well, let's think about international trade. Governments use customs bonds to secure duties and taxes on imported goods,
Oh, okay.
make sure they get their cut, even if payment isn't due right away.
So it's like a financial guarantee that those duties will eventually get paid, even if there's a delay.
Exactly. And there are even specialized customs bonds for different situations. For example, there's the CB1 bond, which is specifically for perishable goods. And then there's the CB4 bond, which comes into play when goods are being, warehoused. It's a whole system designed to keep that international trade running smoothly.
Wow, that's fascinating. I had no idea customs involves so many financial guarantees.
It's a complex world, but those bonds play a pretty crucial role.
Okay, so we've got customs covered. But what about those performance bonds you mentioned earlier? I know those are a big deal in construction. What's the story there?
Imagine you're building a school and you hire a contractor. A performance bond protects you, the beneficiary, from financial loss if that contractor, the principal, fails to complete the project or does shoddy work.
So it's like peace of mind for anyone undertaking a major construction project.
Exactly. And these bonds can be quite substantial, often ranging from 10% to 30% of the total contract value.
That's a huge chunk of change.
It is.
It really highlights how much these bonds matter in the real world, especially when you're talking about something as important as building a school.
Absolutely. They provide critical protection for these major projects, ensuring that even if the unexpected happens, things can still get done.
Okay, so we have a sense of what bonds are, the different types, and how they function in various situations. But let's shift gears a bit and talk about what happens when someone actually wants to get a bond. I imagine it's not as simple as just filling out an application and getting approved. What's that process like?
You're right. It's not a rubber stamp.
Yeah.
There's a lot of evaluation that goes into deciding whether or not to issue a bond. Remember, the surety is taking on a significant financial risk, so they need to be pretty sure that the principal can deliver.
So what kind of detective work goes into this? What are sureties looking for when they evaluate a potential principal?
Well, first and foremost, They're going to scrutinize that client's financial health. It's like a financial health checkup.
Oh.
They'll dig into the applicant's finances,
Mhm.
looking at things like liquidity, which is how easily they can access cash to meet short-term obligations. They'll also assess profitability, which is essentially how much money the company is making. And then there are gearing ratios, which tell you how much debt the company has compared to its assets.
So it's like a deep dive into the company's financial DNA.
Exactly. And for this, they often bring in, financial professionals and auditors to help them make sense of the numbers. They're looking for any red flags that might indicate a higher risk of default.
So what kinds of things would set off alarm bells for a surety? What are some of those red flags?
Well, things like falling profitability, negative cash flow, or even a qualified audit report can make sureties pretty wary. These are all warning signs that the principal might not be in the best shape to fulfill those obligations.
Makes sense.
It's all about mitigating risk for the surety.
So it sounds like issuing a bond is a pretty delicate balancing act. You've got to weigh the potential rewards against the very real risks. So how do sureties protect themselves? What measures do they take to avoid, getting burned?
That's a great question. And that's where we get into the world of counter guarantees and collateral security.
Okay.
These are tools that sureties use to safeguard their interests and minimize potential losses.
Okay, let's break those down. What exactly are counter guarantees and collateral security?
Well, counter guarantees are basically backup promises from the principal. It's like saying, hey, if I can't deliver and the surety has to pay up, I promise to reimburse them.
So it's like a safety net for the safety net.
Exactly. But these counter guarantees need to be rock solid. They need to be clearly worded, properly executed, and backed by a principal who can actually, make good on their promise.
Right, because a worthless guarantee isn't going to do anyone any good. It's like asking your broke friend to co-sign your loan. Not exactly reassuring.
Exactly. And that brings us to collateral security, which is another powerful tool. This involves the principal pledging specific assets as a form of security for the bond.
So it's like putting down a deposit for an apartment. You trash the place, they can use your deposit to cover those damages.
That's a great analogy. The principal is essentially putting up something valuable to show they're serious about fulfilling those obligations.
Okay.
And the surety has the right to take possession of that collateral if the principal defaults.
I can imagine evaluating this collateral is a pretty meticulous process. What kinds of things do sureties need to consider?
Oh, absolutely. They need to be incredibly thorough. They look at things like the current market value of the asset, its expected depreciation over time, any existing liens or claims on it, and of course, whether the principal actually has clear ownership.
Right. You wouldn't want to end up in a situation where the collateral is tied up in some legal battle or turns out to be worth, way less than you anticipated.
Exactly. And it's not just about the asset itself. Sureties also have to consider the legal environment in the principal's jurisdiction. Laws governing the seizure and disposal of assets can vary significantly, from one place to another. And those nuances can have a big impact.
Wow. It's amazing how much due diligence goes into all of this.
It's essential. Sureties are in the business of managing risk, and that means being meticulous about every aspect of the process, from evaluating the principal's financial health to assessing the viability and accessibility of the collateral.
Okay, so we've covered counter guarantees and collateral security. Now let's circle back to reinsurance, because you mentioned that's another key strategy for managing risk in this world. Can you give us a refresher on why an insurance company might choose to share the risk of these bonds with someone else?
Absolutely. Reinsurance is all about spreading that risk, creating a more stable financial environment for the surety. It allows them to take on bigger and potentially more profitable projects without exposing themselves to catastrophic losses if a single bond goes bad.
So it's like a safety net for the surety themselves.
Precisely. And there are two main types of reinsurance that we see in the bond world: facultative reinsurance and treaty reinsurance.
Okay, break those down for me. What's the difference?
So with facultative reinsurance, the surety, we also call them the ceding company in this context, offers individual risks to reinsurers on a case-by-case basis. They basically shop around for the best deal on each bond.
So it's like a custom-tailored approach where they can pick and choose which bonds they want to share the risk on.
Yeah, exactly. It gives them a lot of flexibility to manage their portfolio.
And what about treaty reinsurance? How's that different?
Treaty reinsurance is more like a blanket agreement.
Okay.
The reinsurer agrees to cover a predetermined portion of the ceding company's entire bond portfolio rather than looking at those individual risks.
Got it.
It's more efficient and provides a higher level of stability for both parties.
So it's like having a standing agreement with a friend to split the cost of every pizza you order, no matter the toppings.
That's a great analogy.
You know you're sharing the expense no matter what.
It's about establishing that long-term partnership.
Yeah.
But even within treaty reinsurance, there are different ways to structure the agreement.
Okay, I'm intrigued. What are some of those variations?
Well, two of the most common are proportional and non-proportional treaty reinsurance. Proportional involves sharing both the premiums and the losses according to a fixed percentage. The most common form of this is called quota share, where the reinsurer takes a predetermined percentage of every risk.
So it's like splitting the pie evenly no matter what kind of pie it is.
Exactly. And then we have non-proportional treaty reinsurance, which is a bit more complex. This type kicks in when losses exceed a certain threshold. For example, with excess of loss reinsurance, the reinsurer only covers losses that go beyond the ceding company's own retention limit.
So it's like having a backup generator that only kicks in when the power goes out.
That's a great way to think about it.
It's that extra layer of protection for when things go really wrong. Okay, so we've got facultative reinsurance for those who like a custom-tailored approach, and treaty reinsurance for those who prefer a more standardized and stable agreement. And within those, we've got proportional and non-proportional options to, fine-tune that arrangement. It's fascinating how many layers there are to this.
It really is. It highlights the sophisticated mechanisms that are in place to manage risk and ensure stability in this world.
Speaking of stability, you mentioned earlier that counter guarantees need to be rock solid, but we didn't really dig into why that is. What makes them so crucial?
Ah, that's a great question. It's all about trust and ultimately about protecting the surety's financial well-being. Remember, a bond is essentially a promise backed up by financial guarantees. And if the principal fails to deliver, the surety is on the hook. They really are, and I think it's worth, taking a closer look, especially since you might encounter these concepts in your own life, even if it's not, on a massive corporate scale.
Right, like how many of us have had to put down a security deposit on an apartment or a rental car? Same principle, just applied to a much bigger transaction.
Exactly. So let's start with counter guarantees. You can think of them as a backup promise, a kind of insurance for the insurance. If the principal fails to deliver and the surety has to pay up, well, the principal promises to reimburse them.
So it's a way to shift some of that risk back to the principal. It makes sense. They're the ones ultimately responsible.
Precisely. But here's the thing. These counter guarantees, they aren't just, casual agreements. They need to be meticulously crafted, leaving no room for ambiguity. The wording needs to be crystal clear, and the principal needs to be in a solid position to make good on that promise.
Otherwise, it's like a house of cards, right? The whole thing could collapse if that counter guarantee isn't worth the paper it's written on.
That's a great way to put it.
Yeah.
And that's why sureties often involve lawyers to make sure they're, watertight,
Yeah.
legally enforceable.
Yeah.
It's all about mitigating that risk.
Okay, so counter guarantees are all about having that backup promise in place. But what about collateral security? How does that work?
Think of collateral as a tangible asset that the principal pledges as security for the bond. It's like putting your money where your mouth is, demonstrating your commitment to fulfilling the obligation.
So it's not just about promises, it's about backing those promises up with something concrete.
Exactly. And the types of assets that can be used as collateral are pretty diverse. We talked about real estate and machinery earlier, but it can also include, vehicles, equipment, financial instruments like stocks or bonds, even inventory, depending on the situation.
So it's all about finding something of value that the surety could easily seize if the principal defaults.
You got it. But the surety doesn't just blindly accept any asset as collateral. They do their homework, they'll assess the market value, factor in its expected depreciation, look for any existing liens or claims, and make sure that the principal actually has clear ownership of the asset.
Right, because you don't want to end up in a situation where the collateral is tied up in some legal battle or turns out to be, worth a lot less than you anticipated.
Exactly. And it's not just about the asset itself. Sureties also have to consider the legal environment in the principal's jurisdiction. Laws governing the seizure and disposal of assets can vary from one place to another, and those legal nuances can have a big impact on the surety's ability to actually access and utilize that collateral if things go wrong.
Wow, it's amazing how much due diligence goes into all of this.
It's essential. Remember, sureties are in the business of managing risk, and that means being meticulous about every aspect of the process, from evaluating the principal's financial health to assessing the viability and accessibility of the collateral.
Okay, so we've covered counter guarantees and collateral security. Now let's circle back to reinsurance, because you mentioned that's another key strategy for managing risk. Can you remind us why an insurance company might choose to share the risk of these bonds?
Absolutely. Reinsurance is all about spreading the risk, creating a more stable and predictable financial environment for the surety. It allows them to take on bigger and potentially more profitable projects without exposing themselves to catastrophic losses if a single bond goes bad.
So it's like a safety net for the surety themselves?
Precisely. And there are two main types of reinsurance that we often see: facultative reinsurance and treaty reinsurance.
Okay, break those down for me. What's the difference?
So with facultative reinsurance, the surety, we also call them the ceding company,
hmm
in this context, they offer individual risks to reinsurers on a case-by-case basis. They basically shop around for the best deal.
So it's a more custom-tailored approach where they can kind of pick and choose which bonds they want to share the risk on.
Exactly. It gives them a lot of flexibility.
Okay, and what about treaty reinsurance? How does that differ?
Treaty reinsurance is more like a blanket agreement.
Okay.
The reinsurer agrees to cover a predetermined portion of the ceding company's entire bond portfolio, rather than, looking at individual risks. Got it.
It's a more efficient way to handle a large volume of bonds, and it provides a higher level of stability for both parties.
So it's like having a standing agreement with a friend to split the cost of every pizza you order, regardless of the toppings.
That's a great analogy.
You know you're sharing the expense no matter what.
It's about establishing that long-term partnership for risk sharing. But even within treaty reinsurance, there are different ways to structure the agreement.
Okay, I'm intrigued. What are some of those variations?
Well, two of the most common types are proportional and non-proportional treaty reinsurance. Proportional treaty reinsurance involves sharing both the premiums and the losses according to a fixed percentage. The most common form of this is called quota share, where the reinsurer takes a predetermined percentage of every risk in the portfolio. So it's like splitting the pie evenly no matter what kind of pie it is.
Exactly. And then we have non-proportional treaty reinsurance, which is a bit more complex. This type kicks in when losses exceed a certain, threshold. For example, with excess of loss reinsurance, the reinsurer only covers losses that go beyond the ceding company's own retention limit.
So it's like having a backup generator that only kicks in when the power goes out.
That's a great way to think about it. It's that extra layer of protection for when things go, really wrong.
Okay, so we've got facultative reinsurance for those who like a custom-tailored approach, and treaty reinsurance for those who prefer a more standardized and stable agreement. And within those, we've got proportional and non-proportional options to fine-tune that risk-sharing arrangement. It's fascinating how many layers there are to this.
It really is. And it highlights the sophisticated mechanisms that are in place to manage risk and ensure stability in the bond insurance world.
Speaking of stability, you mentioned earlier that counter guarantees need to be rock solid, but we didn't really dig into why that is. What makes them so crucial to the whole process?
That's a great question. It's all about trust and ultimately about protecting the surety's financial well-being. Remember, a bond is essentially a promise backed up by financial guarantees. And if the principal fails to deliver on that promise, the surety is on the hook.
So if the principal defaults and that counter guarantee isn't, strong enough or they can't enforce it, the surety's left holding the bag.
Right.
It's like lending money to a friend who has no intention of paying you back. Not a fun situation.
Exactly. That's why sureties are so meticulous about not just the principal's financials, but also the strength of that counter guarantee.
Yeah, it's like that old saying, trust but verify. You need to have both.
Absolutely.
Yeah.
And it's not just about protecting the surety.
Mhm.
Ultimately, these safeguards protect the beneficiary too. A strong counter guarantee and solid collateral give them peace of mind, knowing that the bond is backed by more than just, empty promises.
Yeah, it's fascinating how these seemingly complex financial instruments really just boil down to that human need for trust and security.
It really does. Whether we're talking about huge construction projects or international trade or even just renting an apartment, it's all about, creating that framework of trust.
And that brings us to a point I found interesting in these sources. There's this distinction between first demand bonds and conditional bonds. Can you shed some light on that?
Of course. It's a key distinction, especially when it comes to handling claims. With a first demand bond, also known as an on-demand bond, the surety is obligated to pay as soon as the beneficiary makes a valid claim. They don't have to prove that the principals actually breached the contract.
Wow, so it's like a no questions asked guarantee?
Precisely. That's why first demand bonds are typically used in very specific situations where a high level of trust is already there, or where the potential losses are small. It's kind of a simplified way to ensure, swift payment without getting bogged down in legal disputes.
Yeah, it sounds like a powerful tool, but also one that comes with, higher risk for the surety.
Exactly. Sureties need to be extremely careful when issuing first demand bonds because they're essentially giving the beneficiary a blank check. So they're typically reserved for situations where they have a lot of confidence in the principal.
So what about conditional bonds? How are those different?
With a conditional bond, the beneficiary actually has to prove that the principal breached the contract before the surety is obligated to pay. It's more like a traditional insurance claim, where you need to provide evidence of the loss. The surety gets to investigate and determine, if the principal is actually in default.
So it's a more nuanced approach where the surety gets to assess the situation before making a payout?
Exactly. And that's why conditional bonds are more common in situations where the stakes are higher or where the complexity of the project just requires more scrutiny, of any claims. It provides a layer of protection for the surety, making sure they're not paying out on, frivolous claims.
It's like the difference between a refund policy and a warranty. With a refund, you can usually get your money back, no questions asked, but with a warranty, you need to prove there's a defect before they'll honor the claim.
That's a great analogy.
It really captures that difference.
And when a claim does arise, one of the first things the surety will look at is what type of bond it is, because that will dictate how they handle it.
So choosing the right type of bond is crucial. It's like selecting the right tool for the job.
Absolutely.
You wouldn't use a hammer to screw in a light bulb, and you wouldn't use a first demand bond when a conditional bond is more appropriate.
It all boils down to, understanding the risks and choosing the right bond to mitigate those risks.
Well, I think that's a great place to wrap things up. We've covered so much today, from the basics of bonds all the way to these more nuanced types of bonds. We've explored the different types, the underwriting process, reinsurance, and the importance of counter guarantees and collateral. I've got to say, I've learned a lot, and I hope you have too. It's a really fascinating world.
It really is.
And to our listeners out there, we want to leave you with a little something to think about. Think back to, why you wanted to learn about bond insurance in the first place. Maybe you're involved in construction, or you're dealing with international trade, or maybe you're just curious about these financial mechanisms. Whatever your reason, we hope this deep dive has given you a new appreciation for the complexity and importance of bond insurance. Thanks for joining us on this journey.